All right, I want to turn now to the broader markets. We're joined by George Young, portfolio manager with Villere Company. So, George, as we were highlighting at the top, we're seeing markets right now rebounding. Actually, NASDAQ just flipped into the red. However, we've got some good economic data. And this week, we've been doing a lot of conversations around how optimistic is too optimistic for the economy. How do investors, guard against some of the headwinds coming from the economy right now overheating?
No, that's a very good question. The biggest problem ahead of us is inflation, and everybody's been talking about the possibility for inflation, what it'll do with bonds, but also what's it going to do to stocks. The good news is that inflation is generally accepted by the stock market buyers, and so there are a good number of opportunities out there right now. I won't argue that the stock market isn't a little bit expensive at present. But we're bottom-up investors at Villere Company, and we find that in our mutual funds, our Villere Balanced Fund, we can often find plenty of opportunities for those companies that, as bottom-up investors, have gotten beaten up. So I'm happy to share a couple of those with you if you'd like.
Yes, George, we'd love for you to. But first, let me just ask how you are helping clients hedge against inflation. We were talking the other day with an analyst who said, it's interesting, gold, which has sort of been the historic hedge for inflation, hasn't been doing much. And it seems as though people are treating Bitcoin and other cryptocurrencies as that hedge. How are you recommending your clients do that?
Well, we tend to stay away from commodities, and also we tend to avoid popular trends. That's something that can get you in trouble. So what we'd rather look for is consistent sort of plays. One of those would be Ehealth, which I would think few of your viewers have heard of. But here's the interesting thing. Ehealth is a company that supplies Medicare supplements. There are 10,000 Americans turning 65 every day. What that means is they're going to be on Medicare, but they're going to need the Medicare supplement, which isn't that expensive, but it's extremely complicated. So companies like Ehealth are great at guiding unsophisticated purchasers of insurance, and that can be everybody, including doctors, surprisingly. Medicare is very complicated. The important thing is that they know how to market to seniors, and the other interesting fact is that right now they're getting some capital from a well-known company called Hedge that's going to close shortly. That's public knowledge. With that knowledge comes Hedge's background within the health insurance industry. And also, maybe to complicate things, but it could make it interesting, there are two activist investors who have taken sizable positions in Ehealth. Don't know how that's going to end up, but it's a great company that has a lot of catalysts, and a lot of people don't know about that. That's what we try to do, is find undiscovered companies, kind of diamonds in the rough, if you will, in the small and mid-cap territory. And I still think there's value there, irrespective of the market being somewhat expensive.
So, George, speaking of value, I'm again looking at the three majors right now, the NASDAQ in the red, S&P 500 and the Dow, of course, still in the green right now. And I feel like we've constantly had this conversation as we see that rotation out of some of those tech stocks around that value versus growth. We've had a couple of different folks tell us a couple of different approaches, the barbell approach, looking more towards value, looking more at some of the cyclical names. How are you approaching that debate going forward, especially as we see investors still glomming onto some of these more speculative moves? We're still talking about GameStop. We still have those conversations around cryptocurrency.
Right. Oh, it's a great argument, and we'll take the value side of it because I think at the end of the day, the market responds, and buyers should be respectful of the metrics in valuation, and mind those metrics when they're buying stocks. So you want to look for cash that the company's generating. You want to look for a relatively reasonable earnings multiple. So that involves PE versus growth, and there should be a balance between those two. The difficulty is that there's a lot of popular stocks that aren't making sense from a metric standpoint. I've been in business here at Villere since 1986. It's a family-run firm. We've seen a lot of trends come in and a lot of trends go out. Unfortunately, this is sort of reminiscent of 2000 when you had the internet bubble, and every stock was grossly overvalued. And we all know what happened. That didn't turn out well. It's like a bad game of musical chairs where all of a sudden there's no chair to sit on. And that's not the way that investors should be approaching. Unfortunately, a lot of people think of this as sort of a casino game where you need to add up by the end of the day, see how your winnings have turned out. This is a long-term haul. And then again, as I think all your viewers know, tax rates are going to go up with this administration, for better or worse. And that means that if you're a short-term trader, you're going to pay through the nose for short-term trading. So we're long-term investors. I would caution everybody that that's the appropriate way to do it. This is an investment, not a gamble.
All right, definitely wise words. Investment, not a gamble. George Young, portfolio manager at Villere. Thanks so much for joining us today.